Hi, Warren William here from Smarter Data. This video is done in collaboration with FINSCREENER. Okay, these are weekly videos and this video is broken down into three sections. First off, a background to the economy, stocks and the stock market. Second, the portfolio, so the top 10, which is up over 33% so far year to date, and portfolio 33 for 2023. So each week we follow the recommendations on CNBC's halftime report and the final trade section. For this week there are 9 stocks and it can be anywhere between 8 to 12 stocks. Third, towards the end of the video, we will review 5 of these stocks with some calculations. So let's get in the video. So first off, the earnings season is essentially finished, so to speak. School is back after the summer holiday. So what is in store moving forward? So far in 2023, the Magnificent Seven have contributed 2/3 of the S&P 500's returns. Will this continue? No, I don't think so. All in all, the earnings reports so far have been better than expected. Okay, to date, around 350 companies have reported. About 78.7% of these companies reported earnings that exceeded analyst forecasts. Okay, very good. But how does this compare with recent reporting seasons? Very favourable, as this figure is higher than the average for the past 4 quarters, which was around about 73.4%. More importantly, the figure of 78% plus is significantly higher than the long-term average of 64.4%. In fact, Q3 2023 earnings season was the highest rate of earnings surprises since the third quarter of 2021. The S&P 500 and the NASDAQ 100 indexes closed the month of August basically flat, down around 1%. The energy sector saved the indexes in August, up 1.7%. Without the energy trade, the returns of the S&P 500 would have been lower. The issue is, how long will this energy trade last? After all, it's a bet on the oil price. Just to keep in mind, energy has actually beaten tech over the past month by around about 770 basis points. The question is, what is ahead for the S&P 500 index and the NASDAQ index, or the QQQ, for the remainder of 23 and into 2024? So let's go over some key points. Inflation release did little to change things in the US. The PCE deflator fell to a new post-pandemic low of 2.1%, and the core was 2.9%. One of the key drives into 2024 will be higher bond yields at the long end of the market. So the AI story, will it be semi, so NVIDIA or Broadcom, or software, so MongoDB or Snowflake? Are we past the earnings trough? I think so. Earnings will gather pace from here. An earnings growth of 12 to 13% for 2024 is not out of the question. Thus, the market EPS could be around about $270 to $271 per share. The S&P 500 forward PE on that basis would be around about 16.5 times. But remember, the equity market risk premium will be about 8%, which will be demand at the minimum a 2% over bonds. So if bond yields track up to around about 6%. The US inverted yield curve will at some point in time rotate into a normal yield curve. The key points will be focused on stocks with growth rate of around about 13% and a forward PE sub 16%. So the S&P 500 has reached a 4-week high of 4,515, give or take. The major indexes turned in their best performance for around 2 months. Tech stocks continued to build on the rally they made the previous week. This raises the question, why did stock indexes fall in August? If it seems that it was the best quarter in 2 years. To some extent, this is a buy on rumour, sell on fact. It's a trading position. When publicly traded companies report their quarterly earnings, they typically provide earnings guidance. The guidance will typically be around how they anticipate their businesses will perform in the coming quarters, possibly even over the next 12 months. At the outset, they tend to dampen their expectations. Also, in the end, they will hold back because they want to beat the estimates. So in the case of NVIDIA earlier this year, they pushed their earnings guidance out for years. It was extremely positive. The move up in their share price was historic, more than doubling. NVIDIA is now a $1 trillion+ market cap company. Let's take a look at the graph. Then in this earnings season, Broadcom released solid earnings and their forward guidance was in line with current forecasts. the stock fell. This was not good enough. If a company reports earnings for the prior quarter that was better than expected, there is the possibility of poor performance in the current quarter, and this can cause stock prices to decline. Okay, so the group called the Magnificent Seven are 7 mega-cap US tech-based companies. Apple, Microsoft, Amazon, Google, Nvidia, Tesla, and Meta. Collectively, they have outperformed the S&P 500 in 2023, at least in part to the boom in AI. Heading into September, the Magnificent Seven make up now 28% of the S&P 500 market cap, and they have contributed over 65% of returns year to date. So, is the US economy moving into a Goldilocks economy? So, not too hot, not too cold, just about right. Yes, I believe so. Consumers are okay, and inflation is heading in the right direction. Into 2024, short-term rates could even start to come down, but long-term yields are likely to move up. That's part of the rotation of the yield curve, and also you have quantitative tightening at that point in time. This is the Fed unraveling its balance sheet of bonds which it brought during quantitative easing. It's not going to happen all at once, but I believe it will put upward momentum towards yields. The overall economy is linked to long-term yields. Just think of housing. So the big unknown out there for me is China. The Chinese economy is weak, but not collapsing. Chinese GDP is expected to be around 5.1% per year and 4.5% next year. And in 2025, 4.5, 4.4. In contrast, the US is expected to expand 2% this year and 0.9% next year, and 1.9% into 2025. While it is not correct to compare the two economies, China against the US, they are very different, vastly different economies. The issue being raised is the drop in growth in China compared to the US with a stable trajectory. In recent months, global data has peaked. Chinese households spend less than planned and save more. Businesses are borrowing and investing less. While the overall job situation is stable, youth unemployment has skyrocketed. Thus, Beijing has stopped releasing the data. China's economic trajectory has changed. Chinese GDP grew at 9% annually from 2000 to 2019. Chinese growth appears to be dropping to half that rate. That rate could drop even further due to massive debt and an aging population. Before the epidemic, the US GDP increased approximately 2% annually. That implies that the US growth remains unchanged for the past 2 decades. Okay, so let's go on to the top 10 stock picks, performance and allocation. Okay, so here we're inside of FINSCREENER, and you can see the top 10 stock picks for 2023. So far the performance is up around about 31.5% compared to the S&P 500, which is up around about 15%. And here's a list of stocks. If we look at the allocation, we can see over here technology, it's sitting up there at 22%, industrials at 22%, and then the remaining 5 sectors, so energy, financial service, consumer cyclical, communication services, they're all around about 11%. Then if we look at the earnings ratings, the strong buys are Bank of America, Chevron and Goldman Sachs. Nothing on a buy. Neutral is 3M. Sell is Broadcom. And then a strong sell is Alphabet, Amazon, Google and Uber. Okay, so let's move on to Portfolio 33. The construction of a weekly portfolio is intended to be a guide on how to invest in stocks. It's intended to be a stock picker's portfolio. So far in 2023, this is the 33rd portfolio. The remainder of the portfolios can be seen on my blog site, www.smartest-data.blog. So we're inside of FinScreener, and let's take a look at the simple stock picker's portfolio. My portfolio is inside of FinScreener to construct Portfolio 33 of 2023. So there's 9 stocks in the portfolio this week. We start with Google, Amazon, Broadcom, Chevron, Boeing, Goldman Sachs, Uber, 3M and Alphabet. And we'll go through 5 of these stocks later on. Okay, so here we are inside of my portfolio is inside of FinScreener, and we've just set up Portfolio 33 for 2023. Let's take a quick look at the sector allocation. So technology is sitting there at 22%, industrial sitting there at 22%, and the other 5 allocations are all sitting there at just over 11%. So basic materials, industrials, energy, financial services, consumer cyclical, and communication services. Let's take a quick look at the earnings ratings for the stocks. On strong buy is Bank of America, Chevron, Goldman Sachs. On a neutral is 3M. On a sell is Broadcom. And on a strong sell is Albemarle, Amazon, Google, and Uber. Okay, we enter all our stock portfolios inside of Access, and this is the 33rd portfolio for 2023. You can see them all written up on my blog site, www.smartest-data.blog. Anyway, so here we go. We enter all the stocks into the database so we can keep a track of when we invested and at what price. Also the watch list, so there's about 150, 160 stocks inside the watch list for 2023. Every time we add a stock, we add it to the watch. So this is all done inside of FINSCREENER. It's a simple stock pickers portfolio constructed under my portfolios. We've got a watch list there, and also we use Access. The key is to find a quick, easy way to search or screen for stocks. On a weekly basis, our portfolio is constructed based on CNBC's program Halftime Report, and the Final Trades is a daily segment where selected stocks are discussed. The selection of final trades is done by a panel of professional investment managers. The portfolios are constructed by a number of stocks, but diversified by sector. It is intended to be a stock picker's portfolio, as you could see. This provides a broad range of stocks, and all these stocks are then registered inside of the watch list. They'll be based on the stocks by the panelists, but also other stocks can be included based on the investment profile of the stocks. Sometimes the panel may recommend broad sector or geographic exposure. This is done by ETFs and can be included at a 5% weighting. So as I say, all in all, the portfolio construction is done in my portfolios inside of FINSCREENER, Access, and watch lists. So let's now move on to the various stocks. First off, Goldman Sachs. So to Goldman Sachs, GS is the ticker. It's a $108 billion market cap company, currently trading around about $327. Goldman Sachs' potential for big returns in 24 is definitely there. It's a leading global investment bank. Activities are organised into investment banking, 20% of net revenue, global markets, 40%, asset management, 25%, consumer wealth management, 15%. Approximately 60% of Goldman Sachs' net revenue is generated in the Americas. Asia is 15%, Europe is 25%. The capital markets are set to come back. Goldman Sachs demands a premium for margin expanding and integrative growth. A general under-evaluation, quality assets, and a judicious share repurchase dividend program. Goldman Sachs has a strong reputation in the financial services industry, a long history and impressive returns averaging around about 20% per annum. Goldman Sachs has an ability to navigate challenges and capitalize on opportunities. This makes it a compelling investment option. Over the past 12 months, the stock is down 1.74%, year-to-date down 4.56%. It's got a forward PE of 9.3 times, current PE ratio of 6.7 times, price-to-book ratio of 1.1, price-to-sales ratio of 2.5 times, and a price-to-cash flow of 2.6 times. Let's go over to FINSCREENER and... So here we are inside of FINSCREENER, and you can see Goldman Sachs is cheap with a forward PE of 9.3 times, and the current PE is 6.7 times, and it also is just trading above book value. So here we are inside of FINSCREENER with Goldman Sachs, and as you can see, there's been a slight increase in the share price over time. So the current PE ratio is 6.7 times, and the forward PE ratio is around about 9.5 times. Okay, so the EPS, the forward EPS, is probably in the area of around about 35 times. If we put that on a PE ratio of, say, around about 12 times, let's do a quick calculation. So 35 times 12.5, that gives us a figure of around about $430 odd. The current share price is around about 327. So it's a good upside. Let's take that 35 and increase that 35.16, and we say, okay, I think that the growth rate is going to be around about 1.2%. It's done that in the past. So there we are, we're on $42. Then if we give that a PE of around about 12 times, we can find a share price target reasonably up around about the $530 mark. Okay, so it's back to me. So there we go. That's how you do a quick calculation to estimate what a potential fair price could be. So I think the 430 and at the most optimistic outlook, 530 is a reasonable price range for Goldman Sachs. And considering the share price at the moment is around about 327. Let's move on to the next stock, Abermale. So Abermale, the ticker is ALB. It's a 23.5 billion market cap company and is currently trading around about $200. This cyclical tailwind in chemicals is what's behind a potential share price rise. The forward PE for ALB is currently 8.5 times. The stock is down due to lithium. ALB is the world's largest lithium producer. A positive outlook for lithium demand due to demand for electric car batteries. ALB manufactures lithium from salt brine reserves in Chile and in the United States, as well as a joint venture in Australia. ALB shares have taken a beating since topping out in July. Investors are assessing the recovery of lithium prices. Due to the recent sell-off, another interesting buying opportunity is present for investors. Over the past 12 months, the stock is down 22.7%, whilst year-to-date it is down 7.65%. The forward PE is 8.5 times, so it is relatively cheap. Current PE ratio of 16.8 times and a price-to-book ratio of 1.1 times, price-to-sales ratio of 2.5 times, and a price-to-cash flow of 2.6 times. So let's go over to FINSCREENER and take a look. So here we're inside of FINSCREENER with Abermale, and you can see here that the share price has had a bit of a rally recently. Look, the forward PE is around about 9 times. So it's not an expensive stock considering the market's forward PE is around about 16 times. This will largely depend on the lithium price. The EPS growth over the past 5 years has been around about 11%. So, it's a story well worth looking at. So let's move on to the next stock, which is Google. Onto Google, GOOGL is the ticker. It's a 1.71 trillion market cap company, currently trading about $135.70. Alphabet is actually the holding company, so that's the ticker for Alphabet. Internet media giant, it has Google and YouTube underneath it. Free cash flow is $6.1 billion, but considering the market cap is $1,710 billion, it's not much. It is facing headwinds. Search challenged by ChatGPT for sure. YouTube is under pressure and ad revenues are falling. On YouTube, they are chasing creators to fund their video uploads. This is a massive miscalculation by YouTube. Video storage is estimated to cost around $8 billion per year. Google generates 99% of Alphabet's revenue. More than 85% is online ads. Other revenue is from sales of apps and content on Google Play and YouTube and cloud service fees. Over the past 12 months, the stock is up 24%. Year to date, the stock is up 54.3%. Forward PE of 19.5 times. Current PE ratio of 17.4 times. Price to book of 4.5 times. Price to sales ratio of 2.5 times. And a price to cash flow of 12.5 times. Let's go to FINSCREENER and take. So here we're inside of FINSCREENER and we can take a look at Google. Look, Google is probably a momentum play on the tech sector. It's a big cap stock. It's under pressure from search through ChatGPT and also YouTube. It's amazing that YouTube, for its size, contributes so much, or so little, I should say, to the profitability of this company. The estimated EPS growth over the next 5 years is 15.3%. We can see the stock is on a forward PE of 20 times. So there is room to grow. So let's move on to the next stock, which is Uber. Uber Technologies, UBER is a ticker. It's a 96 billion market cap company, currently trading around about 46.90. As it moves into profitability, can it move into the mid-60s as far as share price? That's the question. Uber Technologies is a technology provider that matches riders with deliveries, hungry people with restaurants, and food delivery service providers, and shippers with carriers. The firm's on-demand technology platform could eventually be used for additional products and services, such as autonomous vehicles and delivery via drone. So Uber has been plagued with inconsistent profitability. The company built up losses over 30 billion. Uber recently celebrated a significant milestone, reporting its first ever operating profit of 326 million. Uber stock is around 47 per share, as I mentioned. Over the past 12 months, the stock is up 63.3% and year to date up 91%. It's got a forward PE of 41 times. Current PE ratio is negative as it's in losses. The price to book ratio of 8.4 times, price to sales ratio of 2.35 times, and price to cash flow ratio of 66 times. Let's go over to FINSCREENER and take a look at. So here we're inside of FINSCREENER, and as you can see here, Uber has been on a sideways trajectory as far as price goes. Look, the company's in losses. Let's wait to see what happens when the company turns into profitability, which should be next year. So the forward PE is on 45 times, so that's not a cheap stock. The price to book ratio is currently 8.3 times, and the price to sales ratio is about 2.53 times. Probably the best way to look at this company is on a price to sales ratio. Anyway, so as far as that goes, it's probably in line with the market, depending on its growth rate once it turns into profitability. But nevertheless, I think you've got to consider this on a play in the tech sector. So let's move on to the next stock, which is Amazon. To Amazon, AMZN is a ticker. It's a 1.43 trillion market cap company, currently trading about $137.30. Amazon has endured difficult years, high capital expenditure, sluggish demand, and cost inflation, all contribute to a fall in profitability and free cash flow. Advertising, Prime, and third-party sales are examples of high-margin companies that can help Amazon's retail environment and profitability. As the cloud transformation continues and margins recover, the cloud company is primed to flourish. Margin expansion has substantial potential thanks to an improving business mix, cost-cutting initiatives, and lowering inflationary pressures. Amazon's retail division is improving potential growth in international regions with predicted expansion in the cloud infrastructure sector. AWS remains a key income generator for the corporation. Amazon is in a sound financial position with manageable debt and the potential for increased efficiency and profitability. Over the past 12 months, the stock is up 8%. Year to date, the stock is up 64.3%. It's got a forward PE ratio of 21 times, a current PE ratio of 78.8 times, price to book of 6.4 times, price to sales of 2.4 times, and price to cash flow of 22.2 times. Let's go to FINSCREENER. So here we're inside of FINSCREENER, and let's take a look at Amazon. So the price had a recent rise. It was flat a little bit in August, but started to accelerate again. Look, Amazon has faced some stiff competition. Financially, it's very sound, has manageable debt. Let's take a look at some of the valuation rates. So the current PE ratio is 78 times. So it's in a bit of a hope. It's definitely not a cheap stock at that point in time. But if you look at the forward PE, that's at 44.8 times, gets a little bit more manageable. The thing is, can it get back to a growth rate, which will be the estimated growth rate going forward is going to be around about 33.8%. If it can achieve that, Amazon definitely is a strong company for the future. Okay, so that's it for this week. If you like these videos and you like FINSCREENER, the link is in the comments below. Look, also there's the links to the e-brokers. So it's eToro, FX Primus, and First Trade. If you link through those, that really does help the channel. But these videos are here to try to give you an idea of how to follow stocks and how to be an independent investor. So if you like these videos, please hit the like and subscribe, and see you in the next video.